Welcome, everyone. So today we're breaking down a really fascinating day in the markets, a day where everything seemed completely upside down. A day where some pretty terrible news for the economy was greeted with a massive cheer from investors. Okay, let's dive into this. So, if you just looked at the scoreboard for December 3rd, 2025, you'd think it was a pretty solid day. The Dow led the charge, climbing almost a full percent. The S&P 500 also pushed higher, getting, tantalizingly close to a brand new all-time high. And even the tech-heavy Nasdaq managed to finish in the green. So on the surface, a pretty good day, right? But here's the twist. This rally, it happened on a day when some genuinely worrying economic data came out. The kind of data that usually sends markets spiraling down. So that just begs the question, what was really going on here? Why, all of a sudden, did bad news become good news?
To solve this little puzzle, we're going to unpack the day's conflicting signals. Then we'll explore the market's surprising verdict, see how that caused a major shift in leadership, and finally, we'll break down what it all means for you as an investor.
Okay, so let's start with those mixed signals. The market began the day staring down two very different but equally powerful headwinds. On one side, we had a major shock to the economic system. And on the other, specific worries were hitting the biggest stocks that have been, carrying this market all year. And here is the core dilemma investors were facing. On one hand, the ADP private sector jobs report comes in with a stunning loss of 32,000 jobs. I mean, that's a huge miss that immediately raised the specter of a recession. At the very same time, a report surfaced that Microsoft was lowering its AI sales targets. Now, even though it was later denied, it sent a shiver through the entire big tech sector. So, a weakening economy and potential trouble in the market's leaders, that's a really tough combination. So, faced with these conflicting and, frankly, concerning signals, how did investors react? Did they panic? Did they start selling off? Nope. They focused on one single, powerful idea. Instead of focusing on the risk of a recession or a faltering tech rally, the market looked at that terrible jobs number and it saw one thing: a clear path forward for the Federal Reserve to start cutting interest rates. And just how certain was the market about this? Well, in a flash, the probability of a Federal Reserve interest rate cut in December shot up to 90%. That weak jobs report wasn't seen as a problem. It was the permission slip the market had been waiting for. And this, folks, is a textbook example of the bad news is good news scenario. In this kind of environment, weak economic data wasn't a reason to fear a recession. It was the green light investors had been waiting for, signaling that cheaper money was on the way from the central bank. Now, this interpretation was strengthened by a few other key factors. While the jobs report was weak, the ISM Services Index actually came in stronger than expected, which suggested the economy wasn't completely falling off a cliff. Plus, some political news that a known dove, Kevin Hassett, was being floated as the next Fed chair. And a dove is just someone who typically favors lower interest rates. That added even more fuel to the rate cut fire. So this verdict, that rate cuts are coming, it didn't just lift the overall market, it fundamentally changed where the money was flowing. A major rotation began to unfold right before our eyes. We saw a really clear rotation out of the technology sector and into more economically sensitive or cyclical sectors. Energy and financials were among the day's strongest performers. Now, these cyclical sectors, they're more tied to the overall economy's health, and they often benefit most when borrowing becomes cheaper. So this is a classic sign that investors are betting on a broader recovery fueled by lower rates. And if you want the most telling sign of this shift, look no further. We saw a massive outperformance of small cap stocks, so smaller publicly traded companies. The Russell 2000 index, which tracks these companies, soared nearly 2%, while the tech-heavy Nasdaq barely stayed positive. That shows a dramatic broadening of the rally, as money flowed out of the giants and into these smaller companies that stand to benefit most from lower borrowing costs. So what does this all mean for you? What's the takeaway from this topsy-turvy day? Let's break down the current sentiment and some potential strategies. Overall sentiment turned decidedly positive. The VIX index, which is often called the market's fear gauge, stayed pretty stable. This signaled a risk-on mood has returned, where investors are more willing to buy speculative assets. And if you look at CNN's Fear and Greed Index, it's pretty clear that the hope for rate cuts is outweighing any fear of recession, with the needle sitting firmly in the greed territory. Now, does this mean the tech trade is over? Well, not necessarily. Experts like Keith Lerner from Truist are framing this not as an end, but as a healthy pause. He argues that the fundamental story for AI leadership and strong earnings is still intact,
And what we're seeing is a healthy broadening of the market rally, not a collapse of the leaders.
And we saw this play out in individual stocks. It wasn't just about weakness in the megacaps. Strong performers were popping up everywhere. Marvell Technology soared on great data center sales and a new AI acquisition. Salesforce jumped after hours on stellar earnings. And American Eagle surged over 15% after raising its holiday forecast. So we're seeing strength in software, in retail, and in AI infrastructure.
So this presents investors with a couple of potential paths. The aggressive approach would be to lean into this rotation, focusing on small caps with an ETF like IWM, and on the continued build-out of AI infrastructure with a semiconductor ETF like SMH. A more conservative strategy might look to defensive sectors like healthcare with XLV, or maybe dividend-paying stocks with ZIG to weather any potential volatility.
Ultimately, it comes down to weighing these two powerful narratives. The bull case is strong. Rate cuts seem almost certain, the rally is broadening in a healthy way, and corporate earnings remain solid. But the bear case can't be ignored. That sharp jobs decline could be the first real sign of a recession, and those questions around AI profitability haven't just disappeared.
And this leaves us with a final, fascinating question as we head into the end of the year. For months, the market has been powered by the incredible growth story of AI. But now, a new force has entered the ring, the powerful tailwind of cheap money from the Fed. So which one will be the true star of this market? The promise of future tech or the power of liquidity? That is the key question we'll all be watching.